If you think about your last enterprise deal that stalled at the C-suite level, I'll bet money that the customer executive asked a financial question of you or your champion, and neither of you can answer with confidence. It was probably something like, how does this impact our cash conversion cycle? Or what's the effect of this on our EBITDA margin? And you completely froze. You had no answer. Well, after 20 years in enterprise sales, including 13 years at Oracle and closing multiple deals at or over $50 million, I can tell you that the gap between sellers who close mega deals and those who don't often comes down to a single skill: financial fluency. In today's macro environment, the CFO is the new CEO. So if you can't speak their language, your deal has virtually no chance. That's why in this video, I'm going to break down exactly what financial fluency is, why it matters now more than ever, and how you can develop this skill to start earning executive access and keeping it and closing bigger deals faster. Let's dive in. In this video, I'm going to give a complete overview of understanding financial language and statements for tech sellers. I'm going to cover the 3 main financial statements and where you can find them in SEC filings for US public companies and public data sources for finding financial signals for private companies. But before we get into how this works, we need to be honest about why it matters. If you're losing momentum in enterprise deals right now, it's probably not because your product isn't any good or because you need better discovery questions. It's because at the executive level, you don't know how to convey your messaging in the language that your customer executives are using to frame their priorities and to determine where they're going to be deploying capital this year. Now, the reason that's critical for B2B sellers right now is that the buying environment has changed. Boards are tighter. Capital is more expensive. CFOs are under intense pressure to defend every dollar spent. And that means opinions, enthusiasm, strategic upside, all these things don't carry weight anymore in tech decisions. Numbers do. When an executive asks about your product's impact on EBITDA or working capital, and you can't answer confidently, you don't just lose the question, you lose credibility. From that moment on, you're no longer a candidate to be a strategic partner. You're just another seller to be ignored. In the mind of the customer executive, if you can't explain how your solution impacts the financials, you're forcing the executive to do that mental work for you, and they just won't. Or they'll be way overly conservative and definitely skeptical. They'll essentially write you off, and you'll never get another meeting with them. Financial fluency is the difference between getting pulled into the conversation and getting sidelined. It's how you survive procurement. It's how you keep deals alive when budgets freeze. And it's how you earn the right to stay in the room even through reorgs or when your main contacts leave or get fired. Most sellers never learn this, which is exactly why the ones who do consistently close bigger deals with less friction. So for the rest of this video, we're talking about how executives actually evaluate decisions and how you can align your message to the outcomes they're measured on. Let's start with the foundation, the 3 financial statements every enterprise seller needs to master. So the 3 financial statements are the income statement, the balance sheet, and the cash flow statement. Let's start with the income statement. Think of this as the company's scorecard for making money. It answers one simple question: is this company profitable? And if so, how profitable? For example, if a company's doing 100 million in revenue, this sounds great, but if it costs them 95 million to make that money, that's only a 5% profit margin, which isn't so great. So when you look at an income statement, you're trying to figure out for every dollar this company earns, how much they actually get to keep. Here's how to do it. First, look at their revenue and compare this year's to last year's. Is it going up, down, or sideways? If revenue is flat or shrinking, that's a company under pressure. Second, look at their costs. And there are 2 types you care about. The first is what it costs them to deliver their product or service. So if you're selling software, that's your servers, your engineers, your support team. And this shows up as cost of goods sold, or sometimes cost of revenue. So take their revenue, subtract this cost, and you get gross profit. If that gross profit number is getting smaller over time, it means the company is spending more to deliver what they sell. This is your cue to position your solution as a margin protector. Don't talk about features. Talk about how you automate manual work or reduce the cost of goods sold. The second type of cost is everything else. Their sales team, their marketing, their office rent, their executives, and this shows up as SG&A, which stands for Sales, General, and Administrative Expenses. Think of this as the overhead or the back office costs of running the business. If you see SG&A climbing fast, they're investing in growth. If you see it cut, they're tightening their belt. For a company cutting SG&A, your conversation must be about consolidation. Show them how your tool replaces 3 other legacy systems, effectively lowering their overhead. By the way, if you find this valuable and you want to see me break down real financial documents, I'm hosting a free financial fluency webinar, which you can register for using the top link in the description. But back to the video. Let's talk about the balance sheet. If the income statement is the scorecard, the balance sheet is the health check. It answers a different question. How strong is this company financially? Can they survive a bad year? Are they sustainable as a business? Can they afford to invest in something new? The simplest way to think about this is to imagine you're looking at your own personal finances. On one side, you have what you own: your house, your car, your savings account. These are assets. And on the other side, you've got what you owe: your mortgage, your car loan, your credit card debt. These are liabilities. The difference between what you own and what you owe is your net worth. And companies work the same way. The difference between the two is called equity, and that's what the company is actually worth on paper. So here's what you're looking for. First, look at their cash. How much money do they have sitting in the bank right now? This tells you how much runway they have. A company with $500 million in cash can weather a storm, but a company with $10 million in cash is living paycheck to paycheck. Second, look at their debt levels. How much do they owe? And when do they have to pay it back? Short-term debt means they owe money within the next 12 months. So if that number is high compared to their cash, they're definitely under pressure and they need to find that money from somewhere. Long-term debt is money they owe over several years. This is less urgent, but if it's climbing fast, it means they've been borrowing heavily, and every dollar they pay in interest is a dollar they can't spend on growth. That matters to you as a seller because if a company has lots of cash and low debt, they can afford to invest. They're thinking about growth. So your conversation should be about opportunity and acceleration. But if a company has low cash and high debt, every purchase gets scrutinized because they're thinking about survival. So your conversation needs to shift. It's not about growth. It's about being efficient and saving costs. You need to show them how spending money with you actually saves them money somewhere else. Okay, finally, let's cover the cash flow statement. This one is almost like a lie detector test for companies. What I mean by that is the income statement can be manipulated. Companies have accounting tricks to make revenue look higher or expenses to look lower, and it's not illegal, it's just how accounting works. Cash doesn't lie. Either the money came into your bank account or it didn't, and either the money went out or it didn't. And the cash flow statement tracks exactly that, the actual money moving in and out of the business. It's split into 3 sections, and each one tells you something different. The first section is operating cash flow, and this is money generated from the company's actual business. They sold products, customers paid for them, money came in, they paid employees, money went out. This is the most important number because if operating cash flow is positive and growing, it means the core business is healthy and they're making real money from real customers. But if operating cash flow is negative or shrinking, that's a warning sign because it means the business itself isn't generating enough cash to sustain itself from operations. The second section is investing cash flow, and this tracks money spent on long-term investments. Buying equipment, acquiring other companies, building new facilities. This number is usually negative, and that's okay. It means they're investing in the future. But if it's massively negative, while operating cash flow is weak, they might be spending money they don't have. The third section is financial cash flow, and this tracks money from loans and investors. Did they borrow money? Did they raise funding? Did they pay back debt? An unhealthy company burns cash from operations and fills the gap with debt or investor money at too great a margin. When you understand this, you know exactly how to position your solution. So for a healthy company, you talk about acceleration and competitive advantage. For a struggling company, you talk about stopping the bleeding and improving efficiency. Okay, now that we understand the 3 financial statements, where do we actually find them? For any public company, meaning any company traded on a US exchange, all of this information is available for free in something called a 10K. A 10K is the annual report every public company on a US exchange is required to file with the government, and it's a gold mine for sellers. Yet most of your competitors will either never open a 10K or they don't know how to interpret it. The 10K has several sections, but here are the ones that matter most for sales. Number 1, the business section. This is where the company describes what it actually does. I know you think you know what your prospect company does, but read this section anyway. You might discover that the product you thought was their main business is actually only 20% of their revenue. Or you might find out they're expanding into a new market, or you might realize you've been talking to the wrong department entirely, or there's an upcoming layoff coming and you can get ahead of it in terms of who are going to be your main contacts. Number two, the risk section is pure gold because that's where the company lists everything that could go wrong in their business. This matters because if something's listed in the 10K as a risk, it means the C-suite is thinking about it, and anything that has their attention likely has budget attached to it. So you should look at the 4 or 5 risks listed, and if your solution helps mitigate any of these risks, you have a running start on every other seller. Now, the business section I already explained tells you what the company does, but the MD&A section, management discussion and analysis, tells you what they're doing about it and the challenges they're facing right now. This is where you'll find the real story because executives are required to discuss what's working, what's not working, and what they're planning to do about it. It's like getting a peek inside their executive meetings. Financial statements is where you'll find the income statement, the balance sheet, and cash flow statements we already covered. The 10K shows these numbers for the last 3 years so you can see the trends. You shouldn't just look at 1 year, compare the numbers over time. Is the revenue going up or down or sideways? Are costs rising faster than revenue? Is their cash position getting stronger or weaker? Now what I've given you here is just the overview. If you want to go deeper in this and see me break down real examples, I'm hosting a free financial fluency webinar, and you can register using the link in the description below. Inside the session, I'm going to show you specific financial triggers that get executives to take your call and how to turn all of your financial research into a strong point of view that will earn you a seat at the table, not only at the C-suite level, all the way up to the board, and the exact messaging frameworks that have helped sellers close 7- and 8-figure deals. So again, click the link below to save your spot in the financial fluency webinar. And if you want to hear my story of how I closed over $150 million in deals, watch this video next. See you in the next one.